All right, good afternoon, everybody, and thank you for joining our financial wellness series, our financial boot camp. My name is Alex Oliver. I'm a financial planner with First National Corporation, and we do this series in affiliation with Schwartz and Schwartz Accountants to try to give a few webinars throughout the tax season, just to give you a little bit more education on a lot of different personal finance topics. Today, we'll be talking about the stock market, trying to get a basic introduction of how the stock market works. My goal for the presentation is not necessarily to make you a day trader today. It's really just to give you more information so you can have some context when you read the news, when you see your portfolios go up and down, and maybe feel a little bit more calm and comfortable about how it works. So that way when things go bad, like we saw in 2008, again, maybe you know a little bit about why things are happening. So we'll stick to some basic concepts today and hopefully, again, give you some good information to work with. Just a brief introduction from First National Corporation. We're a registered investment advisor located on the South Shore in Rockland, Massachusetts. We've been in business for over 30 years now. We have two sides to our practice, wealth management side, which is where I spend most of my time, working with a little over 400 different households. So we're working with their personal finances to help them with a retirement plan, a college savings plan, maybe even helping them with debt consolidation and loan planning. So we manage a little over $450 million in assets in that regard. And then on the other side of our business, our retirement planning practice, where we work with a little over 50 retirement plans, serving as the fiduciary on those plans, managing the investments and helping with the providers that work on those retirement plans. As I said earlier, we have a whole boot camp series that we're working with in 2019. This, as you can see, is our third webinar of the season. So why do stocks go up and down? A stock market introduction. Previously, we had done an economic and investment overview for 2019, looking at a lot of different economic indicators to give an outlook of what might happen. And then before that, we had also done a whole webinar on Social Security, different timing strategies and things to consider before actually claiming your benefit. In a few weeks, if you'd like to tune into our generational wealth transfer 10 best practices, this would certainly be most suited for, let's just say, those age 65 and over that may have a financial plan in place and know where they're going to land as far as assets go, and may want to start thinking about pushing those assets to their heirs or to charities during life, and what might be the most efficient way to do that. So I think that might be an interesting one to tune into. All of these can be found on schwartzaccountants.com/events if you'd like to register for the next one. And then in addition to the ones I mentioned, we also have all of last year's webinars, the ones that we've done both during tax season and throughout the year, out of a variety of different topics, tax law changes, as I mentioned earlier, a lot of talk about loans, student loans in specific, estate planning, college costs, a lot of nice topics here that, again, might help you get a little bit of a window as to how First National Corporation and Schwartz & Schwartz really tackle these issues and get you to know our philosophy, okay? So again, schwartzaccountants.com/events if you want to see all of those. So before we get into our webinar today, just a quick disclosure. Everything I say today really should not be taken as advice. I wouldn't go trading your accounts on anything I talk about today. These are just general principles that we will be discussing. So before doing anything, I would consult some professional advice or consult your own advisor. So today I want to talk a little bit about, again, the stock market, why stocks exist, the behavioral aspect behind the stock market. There's a lot of, again, really hard things that we'll go through today, maybe the hard aspects being the numbers, but then the soft aspects being how emotion plays into the stock market. We definitely need to acknowledge that. There are many different kinds of companies, different kinds of stocks out there that we need to understand. There are different ways of analyzing stocks that, again, I want you to at least be introduced to and be aware of. And then finally, stick around toward the end because I am going to give you a few different books that I know I've read as I've come up through my finance schools and really put in the foundation for understanding how the market worked. So I'll definitely talk about those here in a little while. Okay. So for a lot of this presentation, I'm going to talk about Apple because Apple is certainly the most familiar company that everybody has, I think, on their minds. When I work with a new client, if they're investing on their own into individual stocks, it's almost, across the board, if there's one stock that they probably have shares of Apple or have had them at some point in their life. And so let's try to understand the evolution of Apple, because this is a company that was founded back in 1976, as you already know, by Steve Jobs and Steve Wozniak and a guy named Ronald Wayne. Ronald Wayne's kind of funny because he was a 10% owner at the get-go, and then they bought him out, I think, a couple of years after that for $800. And if you read some articles online, that would be worth hundreds of millions of dollars this year or now if he had held on to that. But they bought him out for a whopping $800. So really, just Steve Jobs and Steve Wozniak. So founded, and then 4 years later, they had their IPO, their initial public offering in 1980. And this is when they sold shares to the public. So they no longer owned 60 and 30%. They owned a much smaller percentage of the company, sold those shares and made a profit. We'll talk about how that works. And then when Apple went public, this was one of the largest IPOs in history, the largest since Ford Motor Company, and created about 300 millionaires. Okay, so let's talk a little bit about why a company might do something like that. Why in the world would Apple want to sell off their shares? So when Apple's small, when it's not making a lot of money, again, they just own their company, and then the money that they make, their quote unquote salary, is whatever profits are coming in from the company. But Apple may not have actually had a lot of profits. I really couldn't tell you for sure, but it may not have had a lot of profits back in 1980 because typically, especially with a technology company, they are taking any profits that they have and putting that into research and development so that way they can have newer Macintoshes, newer iMacs, or newer iPhones, so that way they can, again, compete against people like Microsoft and make sure that they don't go out of business. So, those owners, while their business might be worth a lot of money, they might not have a lot of money personally. Okay, so why you might IPO? The company might want to add additional capital, so they might sell 50% of their ownership stake off. They'll raise millions of dollars, and now that additional capital can again go and be reinvested into computers to compete against Microsoft and other competitors. They may want to just simply reduce their holding and have something on the sidelines, something diversified into other investments or other private uses, because obviously if Apple is where all of their equity is, if for whatever reason Microsoft were to beat them one day and they never cashed out, that company is bankrupt and they're left with nothing. So again, even after the IPO, Steve Jobs, Steve Wozniak still have a significant share of the company, so they can have some upside, but they've sold off a piece of the future profits to have some cash to work with now. Another couple of reasons, the company might be listed for ways of providing equity to other people within the company. So as a company goes from 10 employees to 100 employees to 1,000 employees, there's ways of compensating people without just giving them a salary that they may not have. They can actually issue them shares of stock, and it's much easier to do that when the stock is public than when it is private. So, if there's any, say, software engineers listening to this presentation, it's very common for young tech companies to give them some sort of share ownership that might vest over a certain amount of years. And again, instead of just trying to pay them hundreds of thousands of dollars in salary, you might pay them a much lower salary and give them shares of the company instead. So going public definitely helps with that. And then finally, building up your brand, building up your legitimacy in the corporate markets. It might help. I think this is a little less common today in 2019 because companies like Uber, for example, have done well without going public. But even with that case, as lenders look out and they want to see a stable company that they can invest in, going public, certainly helps with that, to show that hey, our stock price, it stays here, our earnings are very consistent. You can open up our books, see our profit and loss statement, and everybody's on the same page with where we're at. So that's a few reasons why they might initially decide to go public. Once they go public, we all become some sort of shareholder in the company. So when I own a share of stock, I am owning, as it says here, 0.00001% to some degree. Any company may have any amount of shares within the company, thousands or millions of shares, again, depending on also what the price of that share is. But for example, I might own a share of Apple. Today it's trading at $171 a share. So again, that one share gives me the right to some of the profits within that company, but again, a very small amount of those profits. There are hedge funds, mutual funds out there that certainly own much more, but it's very hard to become a majority owner in the company, obviously, because there are just so many shares out there and there's only so many that are for sale on a given day. And once somebody gets over 5% in ownership, they actually have to make a complete disclosure to everybody out there. So that way, in the past, it might have been easier to try and take over a company by acquiring shares, but not so much these days. So very rarely does one person not already affiliated with the company own more than 5% of the company. Okay. So how do I make money as a shareholder? That's probably important. If I'm investing within my retirement account or my college savings account or whatnot, how would I make money? I think the easiest one to understand would be directly through dividends. So you might buy a stock like Coca-Cola or Johnson & Johnson, and then every quarter, roughly, they might make a direct payment. So they might pay out 10 cents a share. This is saying that if Coca-Cola has, $100 million in profits, they're going to pay a portion of that out directly to their shareholders, and that's just literally a check. That's just literally coming to you and flowing into your account, and you can do whatever you want with that. So people that are, especially in the retiree phase, where they might want to get, a consistent 3 to 5% income on their investments, dividend stocks are very appealing to them because the only companies that would pay out dividends are those companies that have very stable and predictable cash flow. So they know that if they've committed to 5 cents a share or 10 cents a share, that every quarter they're going to be able to do that. And there's a lot of companies out there that have done the same dividend or increased it for 30 or 40 straight years. And again, if you're looking for a consistent income while you're retired, that's a great company for you to hold. Now, you might not get a lot of appreciation on the share price, but the dividends will make sure that you have a nice, consistent income. So that's one way. And then obviously the one that we're really familiar with would be stock price appreciation or depreciation. So when a stock goes up, if I bought Apple at $171 a share and now it's $201 a share, I can sell that. And then for every share I just sold, I made $30 a share. This one is a little bit harder to predict, obviously, because the shares are for sale on an active market and they will fluctuate based on supply and demand. So if Apple recently released their earnings report and they were more profitable than was expected, people might want to actually pay $200 a share, $230 a share. And the reason that they would pay more is because they're expecting in the future, Apple is going to have more profits and that Apple is going to be worth more as a company today, in the future than it is today. Okay, so that's an exchange between buyers and sellers. That's what they basically, in an essence, negotiate a price that they're trying to sell back and forth to. This is an important concept, I think, to understand because a lot of times when I see maybe a new investor try to decide what company they're going to buy, again, Apple being a very common one of my first questions I really would like to ask them is, at what price are you going to buy Apple stock at? So a lot of us might invest in Apple because they have great iPhones, they have a great company, great business, but at what cost? Is it $170 a share? Is that the right number? Is it $200 a share? Is it $230 a share? As we saw back in 1999 and 2000 when we had a technology bubble, there were a lot of people that were paying a lot per share for companies that were not making money yet. Now, that's not necessarily a bad thing. Amazon is actually a really great example of a company that did not make money for a really long time and was still able to return a lot of value to its shareholders. But you have to have a really good story or philosophy and to some degree, some analysis to figure out, I like it at $50 a share, but I don't like it at $100 a share. So if I buy it at 50 and it rises to $102 a share, I'm going to sell it at that price because I don't like it at that point anymore. So I want to talk a little bit about how we might get into that analysis and have a little idea as to, what we're doing here. Now, beyond the numbers, before we get to the numbers, again, we really need to acknowledge the emotional roller coaster that stocks go through because One thing that we should also understand is when we're investing in a stock, we have opportunity costs with that money. We've decided that we don't want to put that money somewhere else. We do not want to hold it in cash because the interest rates are too low, or we don't want to invest in bonds, or we don't want to buy properties. We think that this share of Apple stock is going to make us the most money. Now, the better question might be, at what time period is it going to make us the most money over the next 6 months, 1 year, 10 years? That might depend on your goal there. But as the news comes out, as things happen in the economy, we all go on this emotional roller coaster. And what is very typical for the average investor is to see their stock go down and want to actually sell it at its low price. Whereas when it goes up, they actually want to buy more and be even more invested because that's it feels good to see our stock go up, and that's if Apple, we bought it at 170, it goes to 200. Well, we're really happy about that. We just made money, and now we might even buy more at $200 a share. I might actually encourage you to reverse the wires in your brain to try and think in an opposite manner. Whereas if you bought Apple at $170 a share and it fell down to $140 a share, and if nothing else changed, if all of your analysis was correct and it still made the money it was supposed to, but just for whatever reason, there might just be some bad news or some negative sentiment, you should actually like that stock more at $140 a share because it's $30 cheaper than when you bought it at. So again, we typically have to have an opposite reaction to that. When it's lower, we actually then want to sell it. When it's higher, we want to buy more. The best investors are the ones that can stay patient, stay calm, and really take an objective point of view there. Okay, so at this point, I think I really want to introduce this quick story because this is generally considered the first recorded speculative bubble, and I think this is going to be a story that sounds really familiar to a lot of people. So this is called essentially Tulip mania. So this is back in the 1600s. Essentially, tulips were brought from Turkey to the Netherlands, and it was a really rare flower. So I guess a virus got into this flower and made it look very different. It had very different colors, and the price of a tulip began to rise, and it began to rise rapidly. You can see we're only going from November 12th to November 25th to December 1st, and how much a tulip actually costs. It got to the point where people actually were dealing within tulips. So people were starting new gardens. They were growing these tulips. People were buying them very quickly. In fact, they were starting to sell land for these tulips. They were getting all of their life savings out of whatever cash they had, and were now accumulating tulips, which just sounds completely bizarre. People were trading within tulips. You might trade 5 tulips for your groceries over the weekend. It's just kind of funny to think about. What ended up happening was a lot of these people were actually selling these tulips to foreigners, people that weren't from the area, that didn't really know much about it, but the foreigners kept seeing them go up in price and didn't really understand why. They just knew that they had to get in on it. And then, of course, too many people started growing these tulips. There was too much supply for the demand. The experienced investors started unloading their tulips, and of course, the price went down to what a tulip might cost today, just a regular price. So the old saying goes, it's better to stop and smell the flowers than to actually stake your future upon one. Otherwise, you might end up in a situation where you bought a tulip up here and sold it down here. I don't know if that sounds familiar. Bitcoin comes to mind. We saw that in the last couple of years. Bitcoin price has risen for really no reason and then dropped for really no reason. Penny stocks, other technology stocks, real estate, like back in 2006 and 2007. These things happen, and there's not always a great reason or financial analysis behind it. It just is human emotion getting behind some sort of idea for a short period of time. So we have to be careful and understand that that might be something that we run into with our investments, and we have to have a good reason to be in them. Okay, so let's start to get a little bit more into the weeds here as to what kinds of stocks there are and what we might be investing in. We should know that within the world there are about 125 million businesses out there, but on the public stock exchange, what you could actually buy on the stock market, there's only about 45,000 companies on there. So again, 125 million in the world. This is all of the businesses that you might go see over the weekend that you might buy from, not all of them are public. In fact, most of them are not public. The ones that are public are typically buying from these other private companies. So again, going back to Apple, every place that it buys equipment from or buys supplies from, typically, I shouldn't say every, but typically a lot of those are just private small businesses with, maybe 5 or 10 employees or maybe 100 employees, but still privately held. So we have to understand that, when we're investing in a stock market, we're certainly not investing everywhere. And that's important to understand that we need to be diversified within that space. As you can see here, there are many kinds of asset classes. There are large companies, there are small companies, there are international, there are real estate, there are emerging markets, which are widely considered Brazil, Russia, India, and China. I'll say it even gets more complicated than that because there are what are called frontier markets, which might be Vietnam or Malaysia, things like that. Again, we want to be very diversified and know that we have to have a lot of stocks, a lot of companies to feel like we're holding the quote unquote market. It gets more complicated than that, though, because within those spaces, we have different kinds of stocks. So we have income stocks. These would be the dividend payers like General Motors or IBM. Blue chips, these are people that have been around for a long time. They're very well established and financially sound. This might be a Walmart or an ExxonMobil, for example. Defensive stocks, these are not highly correlated with economic cycles. So United Health, Philip Morris, Coca-Cola, they're not going to be affected by a grand recession because people need to buy their goods and services no matter what the economy is. On the other hand, we have cyclical stocks. These are actually definitely affected by the economy. So companies like Panera or Netflix, when the economy is going great, as we've seen over the last, say, 8 years or so, these companies should outperform. But when things go bad, these companies will do very, very poorly. We might cancel our Netflix subscription if money is tight. And then finally, there are growth stocks. These are traditionally your technology companies, Amazon, Facebook, Microsoft, Alphabet. These are, again, going to do very well in a good economy and should give you more growth over your money than a value stock, for example. But again, in a recession, will definitely underperform. So that's, again, another aspect of the stock market. And then finally, we get into different sectors. So remember, there are different kinds of companies in there. Just because we're talking about large blue chip companies does not mean we're talking about the same kind of company, because within that, we might have consumer discretionary. So this might be hotels, leisure products, or other kind of media, consumer staples, food, beverage, tobacco, and household goods, energy that goes into oil, gas, solar, and wind. Hopefully you get the picture by now. There's just a lot of different ways to break down the stock market. And so just holding a few individual stocks really does not get us diversified. We have a lot of companies out there that we have to consider. Okay, as you start to evaluate what kinds of companies you're going to invest in, just a couple of things I'll say about that. There's really two ways I think that people would label themselves as being able to analyze a company. If I were evaluating companies, I would put myself into this bucket, which would be the fundamental analysis. We'll talk about technical analysis here in a second, but fundamental analysis is really digging into the balance sheets, the profit and loss statements, and trying to compare the fundamentals of that company to other companies within that industry. Now, within that industry is important because if I try to compare McDonald's to Apple or Alphabet to Burger King, these companies operate in completely different ways. They sell things very differently. They have a very different business structure, and it's just going to be comparing apples to oranges. Same thing with small companies versus large companies. Again, not really comparable. So this is just a small sampling. I mean, these are two ratios that people might use. Price to earnings ratio is a very common one. It's just literally the price per share. So let's just say, Apple at $171 per share divided by the annual earnings per share. It's going to give it a ratio. I didn't look this up, but let's just say Apple trades at 20 PE, a 20 PE ratio. We are paying 20 on a ratio basis to own a share of stock like that. Technology companies will definitely be higher price to earnings because, again, we're expecting them to earn a lot more money in the future. Whereas Coca-Cola where again, it's a very stable company. The PE ratio of that company might be more like 10 or 15, a lot cheaper to earn per earnings. So again, we want to compare that because if we compare Apple at a 20 PE ratio, maybe Alphabet or Google is at a 25 PE ratio. They are at least similar enough for comparison purposes. And maybe part of our analysis tells us that, well, relatively, Apple is cheaper than Google right now. And maybe that's one of the reasons why we end up buying Apple over Google. Not because it's $171 a share and it's cheaper than whatever Alphabet's share price is. The ratio is what is important to really look at. Same thing with price to book. This wouldn't be so good for a technology company because technology companies may not have a lot of tangible assets. But for other companies with a lot of equipment, you might look at their overall market cap and then look at their assets minus their liabilities. Hopefully they have a lot of assets and very few liabilities. So their price to book ratio, again, might look a lot better if you're looking at two, very large manufacturers, maybe two plane companies as an example, Airbus and Boeing. You might compare Airbus and Boeing and compare their price to book ratios and see which one is cheaper right now for you to buy. Okay. Technical analysis, in a nutshell, I won't speak a lot about this. What they're really trying to do here is just find some sort of trend. So this is just, an example of a 200-day moving average. So you might look at it over a period of time, and this is a stock, Microsoft, going up and down and up and down. You can see where the trend line is here. And so somebody using technical analysis might get a little bit of an alert for every time Microsoft falls below the trend line. And that might help them to say, well, if it's below their 200-day moving average, this is a good time to buy. And just based off that alone, that would be the reason that they would buy, and hopefully they're getting it at a cheap price. There's a lot of other different kinds of technical analysis. There's support and resistance. There are things that are called candlestick chart and line charts. Again, I won't get into it because it's not really something that I really spend a lot of time thinking about, frankly. Okay. So again, I'm hoping that a lot of these things that I'm talking to you about today helps you to at least understand that it's really hard to find stocks that are going to outperform over time. Really, if you're doing this right, you have to look at, say, one company, McDonald's, and you have to look at all of their competitors and really come up with a thesis. So you have to evaluate not just McDonald's, but you have to evaluate Starbucks, you have to evaluate Burger King, you have to evaluate Wendy's and see what they're trading at. Look at the sector as a whole, see how they're doing. Look at the economy as a whole. If we're talking about a US market-based fast food chain, we need to look at the US economy, have a thesis on that as well. There's just a lot of choices that you have to make there as opposed to just, seeing a good advertisement or seeing a lot of new Five Guys pop up and just buying into their stock. I would encourage you to say that I don't have the time to research all that. And that's really where mutual funds and exchange traded funds come into play. So, as this kind of chart outlines here, all of us investors, we pool our funds, our $10,000 here or $100,000 here, and we make these massive funds and we go give them to Vanguard or we go give them to Fidelity, and they invest within a certain space, say large growth stocks or small cap value stocks. They invest in the mutual funds, and they're the ones doing all this work. This is their full-time job. They charge a fee for us to be in there, so it might be 0.1% or 0.5% of our money goes to pay them. But then they're doing all of this analysis. It's very typical for larger companies to have one person's full-time job evaluating one company. So they just need to know everything there is to know about McDonald's. Now, they'll use all the publicly offered information to do that, but they'll also go on site. They'll go to the corporate headquarters. They'll interview the CEO, the CFO. They'll listen to every earnings call and analyze it to death. I mean, this is, again, their job. And they have to come up with their own thesis back to the fund manager, and the fund manager has to end up deciding whether to invest in McDonald's or not. There's a lot of work that goes into that. And so I would really encourage, using mutual funds and exchange traded funds. You should know that there are different kinds within this category too. As you probably know, there are passive funds, which really just hold all large cap growth companies in the United States. They don't make a call on whether Alphabet or Apple are going to do better or worse over the next 10 years. They just hold their respective percentage of the overall market. So if Apple's percentage is 2% and Alphabet's is 1.5%, that's what they're going to hold, and they're just going to let it ride. And in a lot of spaces, that's actually a great way to go. You're keeping your expenses low because you're not hiring an analyst to look at the two companies. You're just holding it and letting it ride. Especially, in years past when fees were very high, passive funds have done really well. They've actually outperformed actively managed funds. I think as time has gone on, this gap has really closed. And as you look at particular sectors, it actually is in favor of active management. So just as a quick example, if we just looked at the S&P 500, the 500 largest stocks in the United States, I would typically advise my clients to invest passively in that area because there's just so much information on those companies. There's so many analysts looking at it. It's really hard to pick who's going to do the best out of those 500 large companies. So a passive Vanguard or index fund would be great for the S&P 500. On the other hand, emerging markets, again, Brazil, Russia, India, China, all these other places out there, I would not necessarily say that passive management is a great way to go because passive management, again, just holds a bunch of companies and sees what happens, whereas active managers, they can see what's happening with currencies. They can see what's happening with the political environment. They could see where investment capital is flowing. And again, they can get on the ground and really evaluate these companies. And, it's funny, a lot of the clients I talk to when we're evaluating mutual funds, I'll point them to the Vanguard Emerging Markets Fund because that fund has actually been in the 75th percentile over the last 1, 3, and 5 year period. So, if you were holding a Vanguard Emerging Markets Fund and it went up 5%, you might be okay with that. But if you knew that the average emerging markets fund out there was actually going up 10 or 12% per year, you'd be pretty disappointed by that. And so again, after looking at this a lot of time, typically I like to be a little more active in emerging markets or small company stocks, but not so much in the large company stocks. I'll be passive in that kind of area. Either way, regardless of what you decide, I would really not encourage a lot of individual stock investment because, again, there's just so much work that goes into that. Instead, ETFs and mutual funds that pull your money together give you a lot of diversification, give you professional management. You reduce your risk by holding the market. You also reduce your transaction costs because you're not buying and selling, again, Apple or Alphabet or whatnot. You're just investing in the same fund every time, and they're purchasing those for you. It's part of your management fee. And then again, obviously, there's a wide risk of investments out there to suit your risk tolerance and your time horizon for how long you need until the money is going to be utilized. Okay, final thoughts, just really quickly, and this I think was really going to hit this whole presentation's point home. The average equity fund since 1945 has gained 10.81%. So if you just had any equity fund since 1945, you'd had almost 11% annualized returns. But the average equity investor has only had an investment return of about 4.48%. And it's widely understood that 6% gap, why haven't people gotten these returns? It's because they are not buying and holding and reinvesting dividends. They're trying to pick the winners and the losers. They're trying to pick Coke over Pepsi, or they're trying to pick McDonald's over Burger King. And the average equity investor is just not good at that. They're not in tune with all the information they need to fully evaluate a company. They get emotional. Most importantly, when they see stocks go down, that's when they sell. And as I said earlier, that's actually usually the point when they should be buying the stock. That gap has really, I think, helped me to also not invest on my own because, again, for everything I know, I've got my own emotions, my own biases, and certainly not the time to fully evaluate an individual company. And so that's why, as boring as it is, as we get to the end of this, entirely exciting presentation, the real advice that you should have is to buy and hold and not really think about it much further than that. You should have some sort of strategy for allocating your assets. If you're really young, you should be a little bit more risky, emerging markets and small caps. If you're 65, you should be in high dividend paying blue chip stocks. But beyond that, I don't think it has to be much more complicated, and I think you can hire the people to do those things for you and make sure you stay on the right plan. Okay. Last thing I'll just say here, I like to throw this in here because, again, I think a general misunderstanding, if you don't understand how stock markets work, I see a lot of clients that before they work with us, they actually hold a lot of money in cash in their checking account because they just don't know what to do with it. They don't know where to invest in it. And, while we certainly have these ups and downs over the stock market and we have these terrible things that happen, it's hard to watch. But inflation really holds back on your cash. If you're getting 0 or 1% at Bank of America and inflation is 2 or 3%, you're actually losing money on that. Whereas in the stock market is always going to go up eventually. It will always be higher 20 years from now than it is today. And that's just based on inflation itself. If let's just say Apple, we go back to Apple, they're selling their iPhones for X price today. Inflation means that they're typically going to sell those iPhones for more in the future, or whatever new technology they have in the future. We're spending $200 on a phone now. $200 now is going to be $400 later. And as they sell those same products, their profits are going to rise and their share prices are going to rise. So just based off inflation, the stock market will always, over the long term, outperform cash and inflation itself. So again, if you're looking to have an asset that's going to keep up, get you through retirement, you really don't want to have a huge allocation in cash. Instead, you want to really invest for the long haul. And as we said earlier in this presentation, really focus on the kinds of stocks, the right asset classes, the right sectors to get you through the goal that you're trying to get to. Okay. So just a few resources, as I promised at the beginning of this presentation, that I really want to point you to. 3 books that I think are really great to read and give you a little bit of perspective. Simple Wealth, Inevitable Wealth. This is a great introduction as to how investing works and how it affects your overall financial plan. Certainly what I haven't really been able to talk about today. So this is going to help you to outline the plan and stick to it. It's not complicated and it's very short, quick read. So I like that book. A Random Walk Down Wall Street. This is great commentary on how irrational markets can get, and it really pushes index funds and ETFs. It talks about how investors, they make the same mistakes over and over again. You can go back 40, 50 years, 100 years, and we seem to have these similar events happening. So the more you can understand about history, the better off we may be to not repeat it, or at least not react to it when it happens again. And then it dives into some of the more complicated aspects of investing toward the end of it. So again, I think in this order, I might start with Simple Wealth and then go to A Random Walk. And then if you've listened to this whole presentation and just think you might want to make a complete hobby out of investing and really get into the numbers and do some fundamental analysis, The Intelligent Investor is written by a professor named Benjamin Graham. This is actually the guy that taught Warren Buffett. So Warren Buffett actually sat in this guy's class, I think at Penn Wharton, and he wrote a whole book on that. So if you want to know how Warren Buffett thinks, this is basically your Bible on that. It's certainly complicated. It's certainly technical, but the principles are great. I mean, this is actually written in 1949, and as you can see, it's been updated as time goes on, but all the principles remain the same. So, I love that book. It's worth reading, again, just to get some perspective. Okay, so just wrapping up here, again, my name was Alex Oliver, First National Corporation. You can go to our website to learn anything you'd like to about us. We have a bunch of webinars up here. Our blog posts are up here. If you happen to be a dentist, I might encourage you to click on this dentist tab. Just like Schwartz and Schwartz, we have a little bit of a niche in working with dentists because, as I mentioned earlier, not only do we manage retirement plans for small businesses, but we also do the wealth management for our clients. And so dentists, they have a lot of debt. They also have a lot of income. They have to figure out how the heck they're going to get to retirement. So we've actually written a whole ebook for dentists, again, trying to help lay the foundation for them as they're going through their residency years or their early years, and they're buying their practice, and they're trying to figure out how to manage their cash flow, how to manage their tax situation. Again, this stage right here, going into, once you have some money saved up, paying attention to the investments aspect, college expenses, pre-retirement planning. And then finally, when you're getting ready to sell your practice and go off and retire, a lot of things to think about, a lot of ways to get out of that practice there. So even if you're not a dentist, feel free to go ahead and sign up for this ebook. I'd say 80% of the content is still going to be relative to you, especially if you're a high income professional of some sort. A lot of good content in there. So just go to fncadvisor.com/dentists, put your email address in there, and you're going to get an email from me with a PDF format and a Kindle format if you want to read it on your e-reader. But again, a lot of good information there, I think. So that concludes our presentation. Again, here's some links here. If you'd like to stay in touch, go sign up for our blog, connect with me on LinkedIn, or shoot me an email if you have any questions about this presentation. Otherwise, First National Corporation will always take your call. We're a pretty small company, actually. First National Corporation makes us sound huge, but we will always have a human answering that call, so feel free to give us a dial. And again, appreciate you joining us today or even on the recording sometime in the future. And we look forward to seeing you to our future presentations.